If you're looking to maximize your cash value with an index universal life policy, it is critical that you understand some of the base mechanics and terminology. Index Universal Life, or IUL for short, makes use of stock market based index funds as our crediting method to build our cash value over the long run. Remember, the main reason we put these specialized policies together is to get our cash value to grow uninterrupted compound interest that we can access tax free. Our policy should be one of our greatest assets, which I call the foundational asset. If you see my videos, you'll quickly understand that efficient cash value accumulation and growth is paramount. As we like to say, cash is trash, but cash value is king.
With your philosophy today, get out of cash and get into assets because we don't know what's going to happen to the dollar.
Well, cash is always a bad investment.
We want our policies to be as useful as possible during our earning years and even later years so we can build the life we want. Sometimes that means having a large amount of stored up capital to accelerate our small business or investment portfolio. Sometimes it's about a rainy day fund, kids' college savings, or more income in retirement. For a lot of my clients, it's all the above. Either way, with our IUL, we protect our cash value from market downturns with a 0% floor, and we get access to our capital via tax free policy loans. We get benefits from an index universal life policy that we can't get with other investment based vehicles. My philosophy is that if I'm going to be dropping tens of thousands, if not hundreds of thousands of dollars into a policy, I want a pool of capital that I can draw from as well as a nice juicy return to grow my wealth over the long run. And if I can double dip, growing compound interest in my policy as well as my alternative investment, then all the better. This is the basis for the foundational asset, what I personally participate with my own index universal life policy. In today's video, we're going to be going over the concepts behind our cash value accounts return on capital that you should be familiar with when choosing an index universal life policy. By the end of the video series, you'll probably know more about IULs than your local agent does. So let's get started. Hi, welcome to the channel. My name is Joseph Gutierrez, and this is Covered in Compounding. Click like and subscribe to learn why we call high cash value life insurance the foundational asset to build our portfolio and grow our tax-free nest egg over the long run. Now, when it comes to Index Universal Life, we have some interesting tools at our disposal. For one, we have flexibility in funding that allows us to overfund our policy to grow our cash value account. We can do this in a scheduled manner, or we can do this with some random dump in of cash like our unscheduled premium payment that we talked about in one of our earlier videos. Either way, our excess dollars are going to work for us rather than sitting in a bank account doing nothing, losing to inflation. If, for instance, I have a blended designed index universal life policy that cost me, say, $2,200 a year to keep in force, but I can put up to, say, $22,000 a year into my policy, then I can expect about $20,000 loaded to my cash value account if I'm max funding my policy. On that $20,000, I can get a market-like return on my money in a tax-free and deferred manner, which grows my accessible funds even more. Sometimes we get crazy returns like 28% in a year, and sometimes it's more like 6 to 10% average return range. If the market tanks, my $20,000 is safe and unharmed and carries over to the next cycle ready to roll again for the next anniversary term. That's that 0% floor I was talking about earlier. I get all the upside potential without the downside risk. It's pretty cool, huh? But how is it actually done? How do these insurance carriers make those kind of claims? Well, we have to understand that our Index Universal Life policy has two basic internal accounts that our cash value can be applied to. One is the general account and the other is the indexing account. Now, the general account is the carrier's main collection point for premium that we put in our policy. Because life insurance has the one-to-one requirement of funds on hand to potential death benefit claims to pay out, they have to be very selective where they put their money. It needs to be safe, liquid, and generate a reliable return. The general account does this by putting their money into fixed income assets like treasury bonds. If you've ever watched the U.S. Treasury bond issuance of new notes, T-bills, and bonds during the Treasury auctions, you'll see life insurance companies lined up to pick up more, getting that reliable rate of return they need. They stack that with other fixed income assets to generate, in today's numbers, usually around 5 to 6% or so of gross annual return. On the other hand, the indexing account is their investment account where they allow more risk to take place. This is where the carrier applies funds to get that higher rate of return we're looking for. They accomplish this by indirectly investing in index funds. Index funds are essentially a basket of stocks and other securities like bonds and sometimes commodities that's controlled by a fund manager or an investment company. The carrier accentuates its returns by making use of the index derivatives market with an instrument called the call option. Call options significantly multiply our potential returns compared to traditional investing. For those of you that are new to stock market terminology, we'll keep it relatively simple. A call option is a contract made against the future upside performance of a security between someone who owns the security and someone who does not. For IUL, it's a positive bet on the future performance of a particular index fund. So for example, let's call them person A and person B. Person A owns shares of the index fund and person B does not own it but has a positive or bullish view of the fund's future performance. Let's say today's price of the index fund is $100 per share. So person B says to person A, hey, I bet those shares that you're holding will be worth more in a year from now than today. I'd like to make a deal with you. I want the right to buy those shares off of you at today's price of $100 per share between now and a year from now. Person A says, hey, I don't mind, but you got to pay me today for the right to buy these shares at $100. Pay me a nice premium amount and we got a deal. So they write up a call option contract between the two of them. Now, if the price is higher than $100 per share between now and a year from now, like say $120 per share, person B exercises the call option and purchases the share of the index fund at the price of $100 per share. He can then turn around and sell in the open market for $120 per share and he made 20% profit on his money. If the final price is lower than $100, then it doesn't make sense to buy the shares and the contract expires worthless. In either case, person A kept that premium. That's a call option in a nutshell. In an index universal life policy, the insurance carrier marries the general account and the index account by taking the fixed return from the general account and using it to buy call options in the indexing account. This is often known as the option budget. Going back to our original example, let's say we have $20,000 sitting in the cash value account's general account. If the general account produces, say, 5% annually from its fixed income assets, then 5% will be preemptively moved over in the beginning of the term to the indexing account. That 5%, or in this case about $1,000, is our option budget. That's that premium that we use to purchase the one-year call options, just like person A demanded in our example. Meanwhile, in our general account, a year later, the now $19,000 gets its return of roughly 5% added back to the general account balance, bringing it back up to $20,000. This is that 0% floor we were talking about. If the indexing account produces a profit from the call option contract, it then gets added to the total balance of the general account on the anniversary date. Then the next year we take our $20,000 plus our profit plus any newly added contributions we made towards our policy and re-roll again to hopefully make more options profit. This is the compound interest effect that we want. When we have an index universal life policy, the carrier will have different choices of index funds to choose from. Some of those funds are more popular, more volatile in price, and require a higher option budget, while others may be less active, more conservative price action, therefore requiring a lower option budget. If the premium requirement is lower than our option budget, then the carrier can buy more option contracts. So let's say our $1,000 option budget can buy double the call option contracts for that year, and we have a great year and make 20% profit. Then our 20% profit example will actually be 40% credited to us. In IUL terms, this is called our participation rate. It is a multiple applied to the gain of our index. So in this example, the participation rate for the doubling of the option purchase is 200%. Sometimes the option budget is not quite enough to purchase the call options for the index fund. The carrier generally handles this dilemma in two different ways. One way is our participation rate may be lower than 100%. So if it's a 60% participation rate and the index makes 20%, then our crediting for our cash value is actually 12% for that cycle. Another way the carrier can handle this is to actually sell an additional call option at the beginning of the cycle, which in IUL terms is called the cap rate. This is essentially a ceiling. Back to our example. If the index fund is $100 a share, the carrier will put in order to buy the $100 call option and then simultaneously sell a call option contract at, say, $110 per share. If the index fund does 8% that year, we're credited 8%. If the index fund does 20%, then we're credited a max of 10%. In IUL terms, this is called the cap rate. So in this example, our cap rate is 10%. There are other bits of terminology that are helpful to know as well. Things like if you see a fee, then we know that we're paying a little bit more, usually to increase our option budget, so we can get a better return, which may improve our participation or cap rates. Sometimes some carriers will use something called a spread, which gives a certain percentage back to the carrier first as a fee, then the rest is given to the policy owner in their cash value account. Personally, I like carriers that have no spread, no caps, and high reliable participation rates. Now, this is a generalized example of how carriers reward policyholders with index crediting. Remember, as the market changes, so does participation rates, spreads, caps, and bonuses unless the carrier guarantees them in the contract. Some IUL naysayers, particularly whole life only agents out there, will say that this is a fault with the IUL carriers, that they may change the crediting constraints because they're greedy or something. It's a bait and switch operation. This is unfortunately an example of fundamentally misunderstanding how index and in general crediting rates work with life insurance products. The health of the carrier, the mortality trends, the general market conditions, interest rates, secular growth or recession periods, bond yields, current Fed policy, and even global trade policy all have an effect on the returns of the indexing account as well as the general accounts. Some of the loudest detractors, usually our whole life onlyist friends, tend to forget those same metrics affect their whole life general accounts gross dividend rates as well. We've seen whole life gross dividend rates from general accounts drop from the 12% plus in the mid 1980s to 5 to 6% gross dividend rate range in today's low rate interest environment. Whole life has also changed with newer products and lower base designs to compensate for lower dividend growth rates. Is it the insurance carrier's fault, or is it merely a response to changing market conditions, looking for ways to maximize their policyholders' returns and reduce costs? And this is coming from me, a big proponent of whole life and the famed infinite banking concept to grow our wealth. The moral of the story is that whether indexed universal life or whole life, the overall market is the driving force to the policy's compound interest, and that it's all connected. All that said, indexed universal life carriers know the market fluctuations very well and often incorporate new index options or work with their investment fund partners to vary the internal indexing allocations to stabilize and maximize the returns no matter what the overall economy is doing. Like, for example, with carriers like Securian, where they automatically allocate more weight towards fixed income and commodities of an index fund to offset the latest inflation and market volatility of the past few years. Ultimately, insurance carriers want happy policyholders, so they stay with the carrier long term instead of leaving and 1035 exchanging their cash value to a different carrier and a different insurance product. It is a business after all. It suits them to retain their policyholders as lifelong clients by growing their policyholders' wealth over the long run. This concludes the first of our series, Profiting with Index Universal Life. In our next few videos of the series, we'll look at indexing trading history, different index options, and various particulars with our two preferred index universal life carriers, Allianz Life and Securian. We'll also look at how important it is to optimize our designs with blended designs and how they play in building an effective and profitable policy. Thank you for watching. If you are interested in putting together your own personalized policy, feel free to click the link in the description, which will take you to our homepage where you can see much of our information. On that homepage, you'll see a link to book now for a free online consultation. As with all of our consultations, we take a look at your financial circumstances and your goals and how a policy can be used to accomplish them. We also do free policy reviews. If you have a policy that's already in force, we can give you more context and possibly be able to put together a better policy. Once again, thanks for watching. Feel free to click like and subscribe, leave a comment, and I look forward to seeing you on our journey towards financial independence using the foundational asset. Until next time.